Hola, muy buenos días. En nombre de Arpel quiero darles la bienvenida a esta tercera charla del 2024 del ciclo de charlas de intercambio de mejores prácticas de upstream que está organizado por el Comité de Exploración y Producción de Arpel. Para aquellos que nos estén acompañando por primera vez y no conocen qué es Arpel, les comento que es una asociación regional de empresas de petróleo, gas y energías renovables que se encuentra presente en el ámbito de Latinoamérica y el Caribe. Arpel es una asociación sin fines de lucro que fue creada en 1965 con el objeto de promover la integración, la cooperación y la asistencia recíproca entre empresas del sector y para contribuir de manera activa al crecimiento sostenible y a la excelencia operativa de la industria del gas y del petróleo. Actualmente cuenta con 32 empresas miembros que representan un alto porcentaje de las actividades de upstream, midstream y downstream que se desarrollan en Latinoamérica y el Caribe, incluyendo a las principales empresas operadoras nacionales e internacionales, proveedoras de tecnologías, bienes y servicios, y también instituciones nacionales e internacionales del sector. Aquellos que estén interesados en obtener más información sobre Arpel, los invitamos a visitar nuestra página, que pueden encontrar en la dirección www.arpel.org, y allí van a poder encontrar más información sobre las actividades que desarrollamos. Quiero también aprovechar esta oportunidad para comentarles que el próximo jueves 19 de septiembre vamos a tener un nuevo webinar que tratará sobre mejoras en el desempeño del levantamiento artificial y que va a estar a cargo de la empresa Ecopetrol. Todos los que quieran participar son invitados a hacerlo. Bueno, antes de comenzar con esta actividad, les hago algunos comentarios con respecto a la dinámica. Como habrán visto, contamos con traducción simultánea. Para aquellos que quieran acceder a esta opción, pueden dirigirse al icono que se encuentra en la barra, en la parte inferior de la pantalla, un icono de Mapamundi. Ahí pueden seleccionar el idioma de su preferencia, ya sea español o inglés. Si no les aparece ese icono, fíjense, hay otro icono que dice más, ahí van a desplegar un menú y van a poder encontrar la opción de traducción simultánea o interpretación, creo que se llama en español. Bueno, esta presentación, como también se habrán dado cuenta, va a estar grabada, o sea que va a poder ser vista posteriormente en el canal de YouTube de Arpel, donde no solamente van a poder ver esta presentación, sino que también van a poder acceder a otras presentaciones, webinars, workshops que hemos hecho con anticipación. Durante la presentación no va a haber interrupciones, pero sí van a poder ir dejando sus preguntas en el espacio de Q&A o de preguntas y respuestas, que se encuentra también en la parte inferior de la pantalla, en la barra de herramientas de Zoom. Una vez que termine la presentación de Nathan, vamos a abrir un espacio de unos 10-15 minutos para poder contestar las preguntas que se vayan haciendo en este espacio. Por último, cuando termine el evento y ustedes salgan de Zoom, se les va a disparar automáticamente una encuesta muy breve, unas muy pocas preguntas, que les vamos a pedir que completen, porque esto nos va a permitir orientar los intereses para futuras charlas de este tipo. Bueno, a continuación quiero presentarles al ingeniero Raúl Belkenov. Raúl es auditor de reservas en YPF y es presidente del Comité de Exploración y Producción de Arpel y es quien va a moderar este evento. Raúl, buen día. Te cedo la palabra.
Hola, buenos días a todos. Muchas gracias, Pablo, por la presentación, a Arpel y el equipo por la organización del evento, al expositor, al SPE y a todos quienes se conectaron a este webinar. Hoy Nathan, a quien voy a presentar en unos minutos, nos va a brindar una charla sobre valoración justa de mercado de activos de oil and gas, o fair market value. Un tema de gran relevancia, ya que es el punto donde se vinculan los análisis técnicos de reservas y recursos con los temas contables. Es a partir del fair market value que se toman muchas de las decisiones fundamentales en los negocios del petróleo y del gas. El foco en este caso estará puesto en las principales metodologías que se utilizan, los desafíos en su estimación y una visión práctica del proceso con algunos ejemplos también. Sin más, voy a presentar al disertante. Nathan Baumgartner trabaja como ingeniero de reservorios para DeGolyer y McNaughton. En la división AM se desempeñó como ingeniero de yacimiento en Moyes Company, donde como parte de su trabajo profesional realizó evaluaciones de activos para gerenciamiento de portafolios, para litigios internacionales y para procesos de quiebra. Nathan obtuvo su licenciatura en Ingeniería Petrolera de la Universidad de Luisiana en Lafayette en 2018. En diciembre de 2022 obtuvo su maestría en Ingeniería Petrolera en la Universidad de Texas A&M. Su investigación se centró principalmente en la previsión de producción de yacimientos no convencionales. Nathan es miembro del SPE. Estimado Nathan, bienvenido y te cedo la palabra. Muchas gracias.
Thank you, Raul. Before I get started today, I want to thank everybody for attending. I'd also like to thank Arpel for giving me the opportunity to speak today and to share my knowledge with their audience into the SPEE chapter of Latin America. Today, I will be presenting on the topic of fair market valuation in the upstream oil and gas industry. The structure of today's presentation is outlined as shown. I will start briefly by discussing the background of the SPEE chapter of Latin America, DeGolyer and McNaughton, and myself. I'll introduce the subject of fair market valuation in the context of the upstream oil and gas industry, and other key relevant subjects such as technical evaluations and economic evaluations that I consider to be necessary in order to achieve a basic understanding of the valuation process. Following the introduction, I will cover in detail the various valuation approaches applied throughout the valuation process. I will then proceed to discuss practical considerations that arise during the valuation process, namely the differences between valuation practice in the US and abroad. And then lastly, I will conclude the presentation with remarks summarizing the themes that I'll consider in the presentation. I wanted to provide a brief disclaimer just to state that the opinions that I express today are my own and do not necessarily represent the views of DeGolyer and McNaughton or the SPEE. The SPEE chapter of Latin America was formed in 1962 to bring together petroleum evaluation engineering specialists. The group is dedicated to the promotion of the profession of petroleum evaluation engineering by promoting continuing education for its members and by providing education opportunities to the public in the areas of oil and gas reserves definitions, reserves evaluations, and fair market value. The principal goal of the SPEE is the standardization of oil and gas reserves definitions. As shown in this slide, the SPEE has published a variety of publications and resources. These include various monographs related to technical reserves evaluation topics and short papers covering a variety of other evaluation issues. In this slide, you'll see a brief summary of DeGolyer and McNaughton's background. DeGolyer and McNaughton was founded by Everett DeGolyer in 1936. D&M is the petroleum industry's largest consulting firm and has been an industry leader in reserves assessment and technical evaluation for more than 88 years. We are a completely independent employee-owned firm that employs more than 150 technical professionals and maintains offices worldwide. If you want to know more information about the company, you can visit dmac.com. And lastly, a brief introduction of myself. My name is Nathan Baumgartner. I'm a registered professional engineer in the state of Texas, and I currently work as an engineer in D&M's North America and Global Unconventionals division. So I'm going to use this introduction section of the presentation to cover the questions shown in this slide, namely, what is a fair market valuation? Why are fair market valuations typically conducted? And what factors influence value? And before I proceed to answer these questions, I want to clarify for those in the audience that may not be aware what upstream oil and gas companies are and where they derive their value. Upstream oil and gas companies are companies that specialize in the identification, extraction, and production of hydrocarbon products, and their principal assets are their reserves, and to a much lesser extent, their contingent and prospective resources, which I will define later in the presentation. So we should start by defining the term fair market value. Fair market value is the price a willing buyer will pay and a willing seller accept when a property is exposed to the market for a reasonable period of time, neither party having any compulsion to buy or sell, and both having reasonable knowledge of the relevant facts. Another way to think about fair market value is that it's the process of estimating what an asset would reasonably sell for given standard market conditions. Fair market valuations are conducted for a variety of reasons, which broadly fall under these four categories shown: internal planning, legal, regulatory, or financial. The process of determining fair market value is generally a multi-step process. The first step of this process is the technical evaluation, which involves the estimation and classification of hydrocarbon volumes and the generation of production forecasts, which characterize the rate at which these volumes can be extracted or produced. The next step of the process would be the economic evaluation. In short, the goal of the economic evaluation is to determine the discounted net present value of the forecasted hydrocarbon production. This is done by estimating the revenues generated from the future sale of hydrocarbon products and deducting operating costs, capital costs, production taxes, and any applicable royalties to ultimately determine a project's future net cash flow. This future net cash flow is then discounted to a singular present value. This discounted net present value determined in the economic evaluation is referred to commonly as the technical valuation or the technical value. And then in the final step of the process, the technical value is discounted further to account for investor risk aversion. This value is what is referred to as the fair market value. Each of these steps has a significant impact on the ultimate opinion of value, so it's extremely important to understand the nuances involved in each step of the process and how they can affect the overall result. As mentioned previously, the technical evaluation is the first step of the evaluation process and involves the estimation and classification of hydrocarbon volumes. The Petroleum Resources Management System, otherwise known as the PRMS, was developed by SPEE in cooperation with other prominent industry organizations and is the industry standard system for the classification and categorization of hydrocarbon volumes. The PRMS classification framework is illustrated in this slide and shows that hydrocarbon volumes are categorized based on commercial maturity, as shown on the y-axis going up and down the framework, and range of recovery uncertainty, as shown in the x-axis, going from left to right on the framework. At the bottom of the framework in blue are prospective resources, which are undiscovered quantities of petroleum. These resources have the lowest chance of achieving commercial maturity. Once resources become discovered, for example, when a well is drilled or tests oil, prospective resources can then be matured upwards into the contingent resources category, shown in gray. Contingent resources are defined as quantities of petroleum that are potentially recoverable from a known accumulation, but are not considered commercially recoverable at the time due to one or more contingencies. Once the further evaluation of contingent resources indicates that they are likely commercial to extract, they can then be matured to the reserves category, shown in green. Reserves are quantities of petroleum that are expected to be commercially recoverable from known accumulations and must meet four criteria, namely that they must be discovered, recoverable, commercial, and remaining as of a given date. Each of the reserves and resources categories includes subclassifications. For example, the subclassifications for the reserves category are 1P, 2P, and 3P reserves. These subclassifications define the uncertainty associated with the estimate of recovery. For example, 1P, 2P, and 3P reserves are categorized by a 90% chance, a 50% chance, and a 10% chance of recovery, respectively. Once resource volumes are properly categorized, the final step of the evaluation of the technical evaluation process is to produce production forecasts or estimates of future hydrocarbon production over time. The production forecasts are generated for each resource category and are then used as inputs into an economic model. Discounted cash flow models are the most widely used and preferred method for economic analyses in the upstream oil and gas industry. Discounted cash flow models are used to estimate the discounted net present value for each resource category assigned in the technical evaluation. And a discounted net present value is essentially a project's future net cash flow discounted to an equivalent present amount. These discounted cash flow models will incorporate various inputs, such as production forecasts, prices, costs, and ownership, and will reflect the relevant fiscal terms governing entitlements to hydrocarbon revenues. The fiscal regimes that govern entitlement to hydrocarbon revenues vary by jurisdiction, but are broadly classified as production sharing contracts, concessions, or risk service contracts. This figure provides a visual representation of a discounted cash flow model and illustrates how revenue and expense profiles evolve throughout an asset's life cycle. In this figure, the bars below the x-axis represent costs, whereas the bars above the x-axis represent revenues or profits. At the exploration stage of a project's life cycle, the asset will not generate any revenues. Any hydrocarbon volumes assigned to the asset would be considered undiscovered and, according to PRMS guidelines, would be categorized as prospective resources. During this period, capital is spent on geologic studies and seismic surveys in order to estimate potential in-place hydrocarbons volumes and to identify drilling targets. Once an exploration well is drilled and a discovery is made, the hydrocarbon volumes would then be classified under the contingent resource category. The project would then progress to the appraisal stage, where further drilling or testing is conducted in order to assess whether the discovered accumulation can be developed commercially. If the appraisal process indicates that a discovery can be developed commercially, the discovered volumes would then be recategorized as reserves, and the project would progress to the development stage, where additional capital would be devoted to engineering, planning, the drilling of development wells, and the installation of infrastructure. Once development is complete, or once hydrocarbon production commences, the asset would progress towards the production stage of the life cycle, where it will finally begin generating revenues through the sale of hydrocarbon products. The revenues generated are offset by the operating costs, production taxes, and royalties if applicable. And then the differences between the revenues and the expenses would result in profit, which are also referred to as the project's net cash flow. This net cash flow, which you can see in green in this chart, is then discounted back to the effective evaluation date in order to estimate the project's net present value. Once a net present value is assessed for each resource category, the fair market valuation process can begin. This process generally involves reducing a technical risk-weighted value, which would essentially be the discounted net present value determined from an economic evaluation, to an equivalent value, such as a purchase price, that properly accounts for investor risk aversion. When assessing fair market value, best practice is to form a valuation opinion through the use of multiple valuation approaches and to consider all risks, non-fiscal factors, and market dynamics that may apply. This slide presents a non-exhaustive list of factors that may influence the value of any particular asset or company. Asset quality refers to the technical and commercial factors such as reservoir performance and development costs. These factors are explicitly accounted for during the technical and economic evaluations and will affect how much revenue or cash flow a project can generate. Performance relative to similar assets or companies will determine how assets or companies would be valued in relation to other alternatives present in the market. Subsurface risks refer to technical risk, such as the presence of non-sealing faults, changes in reservoir properties away from well control, and other subsurface factors that carry uncertainty and may ultimately impact reservoir performance. These risks are generally accounted for as part of the technical evaluation and would ultimately affect the revenue or cash flow expected to be generated by the asset. Surface risks include regulatory, political, logistical, and bureaucratic issues that degrade performance. The impact of these risks on the ultimate valuation are generally considered accounted for when using a market-based valuation approach. Reserves and resource distribution relates to what percentage of the total resource base is comprised of reserves versus other resource categories. As we will see later, reserves are generally considered to be more valuable on a per unit basis than contingent or prospective resources, as they are less risky in comparison. Product mix refers to how much of the total resource base is comprised of oil, gas, and condensate. Oil, gas, and condensates are priced differently, with oil being the most valuable on a per unit basis. And because of this, projects with higher percentages of oil reserves will generally be considered more valuable than projects with higher percentages of gas reserves, at least on a per unit basis. Fiscal terms refer to the terms of host government instruments, such as production sharing contracts, concessions, or risk service contracts that govern entitlements to hydrocarbon revenues. All things being equal, assets which are governed by contracts with generous fiscal terms or lower state takes will receive higher valuations, while assets governed by contracts with more stringent fiscal terms or higher state takes will receive lower valuations. The impact of fiscal terms on a project's cash flows are directly accounted for during the economic evaluation process. Non-fiscal terms refer to other terms included in host government instruments which are not related to the entitlement of hydrocarbon revenues. These terms would include such things as state participation, preemptive rights, contract stabilization, local content requirements, rights of assignment, renewals and extensions, decommissioning obligations, governance, and cost recovery, to name a few. These terms can have significant impacts on the implementation of the host government instrument and can potentially degrade project cash flows. As a result, their impacts should be considered as part of the valuation exercise. In this next section on valuation approaches, I will cover the various approaches applied during the valuation process, and we'll answer the questions: what valuation methodologies are used in the industry and how are they applied in practice? So there are generally 3 accepted valuation approaches in the upstream oil and gas industry. These approaches include the cost approach, the market approach, and the cost approach. Each approach includes a variety of valuation methods, with certain valuation methods being considered more widely accepted than others. So the first evaluation approach I'll talk about today is the income approach. The income approach covers any methodologies that leverage the outputs of a discounted cash flow analysis. Valuation parameters generated from the results of a cash flow analysis are used as tools in order to form a valuation opinion. And then income approaches are generally asset specific and can address certain current, future, and potential risks by incorporating these risks into the cash flow model. This slide presents a non-exhaustive list of common valuation parameters generated from the results of a cash flow analysis. You'll see 2 valuation parameters related to the discounted net present value, the first of which is net present value evaluated using various risk-adjusted discount rates, and the second of which is the net present value adjusted using reserve adjustment factors. The remaining valuation parameters are the internal rate of return, return on investment, and payout time. And then I will consider each of these valuation parameters in the following slides and provide simplified examples showing how these parameters are used in practice. So risk-adjusted discount rates are rates used to discount future net cash flows to an equivalent present amount. These discount rates are generally higher than standard discount rates used in the industry as a way of giving investors a means of accounting for various reserves-related uncertainties. Ranges of risk-adjusted discount rates for various reserves categories are published annually in the SBEE's survey of parameters used in property valuation. These discount rates are used to discount pre-tax net present values, discount the pre-tax net present values for individual reserves categories. And one observation I'd like to make from this slide and the graph presented here is that The implication is that the value is a function of uncertainty. The reserves category with the lowest recovery uncertainty is the proved developed producing reserves category on the left. The lowest risk-adjusted discount rates are assigned to this category, the result of which would be a higher valuation, as the future cash flow projections are discounted to a lesser degree. And alternatively, possible reserves shown on the right-hand side of the graph have the highest recovery uncertainty. These reserves are assigned the highest risk-adjusted discount rates, the result of which would be a lower valuation, as the associated cash flow projections would be discounted at a much higher rate. This slide shows a simplified example illustrating how risk-adjusted discount rates are applied in practice and evaluation. For each reserve category, I assigned an arbitrary NPV 10. This is shown in column 2. NPV 10 indicates that the net present value was assessed using a 10% discount rate. In the third column, I have included the range of risk-adjusted discount rates that were indicated by the SPW survey results. And then the mean value of the SPW survey results is presented in the fourth column. To apply the methodology, the project economics for each reserves category are reassessed by replacing the 10% discount rate with the mean survey value discount rate shown in column 4. And then the results for each category are shown in the final column. The sum of the adjusted net present values for each category are then added together to form a valuation opinion. So in this example, the original technical valuation using a 10% discount rate for each reserve category was assessed to be $47 million. Once the risk-adjusted discount rates were applied to each individual reserve category, the technical valuation of $47 million was reduced to an implied fair market value of approximately $31 million. Investors are risk averse, and so in this example, the discount applied to the technical valuation is intended to ensure that they are compensated for their relevant reserves-related risks. The next income-based valuation methodology is the use of NPV 10s adjusted with reserve adjustment factors. Similar to risk-adjusted discount rates, reserve adjustment factors are also published in the SPW annual parameter survey and are intended to give investors a way of accounting for reserves risk. Reserves adjustment factors are fractional multipliers and vary depending on the reserves and resource category being considered. They are commonly applied to pre-tax NPV 10s of individual reserve and resource categories. And a key observation I'd like to highlight from the graph shown in this slide is that there's again the implication that value is a function of not only uncertainty, but also of commercial maturity. As maturity diminishes, i.e., as we move from reserves to prospective resources, we'll see that valuations will fall. And then a similar thing happens with uncertainty. As we move from proved developed producing reserves to possible reserves, we'll also see valuations falling. So this slide provides another simplified example, this time illustrating how reserve adjustment factors are applied in evaluation. For each reserve category, I assigned arbitrarily an NPV 10. This is shown in column 2. In the third column, I have included the range of reserve adjustment factors that were indicated by the SPW survey results. And then the mean value of the SPW survey results is presented in the fourth column. To apply the reserve adjustment factor valuation methodology, simply multiply the NPV 10 given in column 2 to the corresponding reserve adjustment factor shown in column 4. The result for each reserve category is shown in the final column. The sum of the adjusted NPV 10s for each reserve category is then used to form the valuation opinion. So for this example, the original technical valuation using a 10% discount rate for each reserve category was assessed to be $47 million. Once the reserve adjustment factors were applied, the technical evaluation was reduced to an implied fair market valuation of approximately $36.5 million. So the remaining income-based valuation parameters include internal rate of return, return on investment, and payout time. Internal rate of return is defined as a discount rate that generates a net present value of 0. Return on investment is the cumulative net cash flow generated by a project divided by the total cost of investment. An ROI of 1 indicates that the project is able to recover all of the capital that was invested. Payout time refers to the time typically measured in years required to recover a project's initial investment. These parameters are generally guided by the minimum corporate investment criteria in a given market. Determining this criteria that sets values in a particular market is sometimes difficult, as this information is seldom disclosed. However, if this criteria can be accurately determined or can be estimated with a reasonable degree of confidence, the process of getting to a valuation using these parameters is relatively straightforward. All that needs to be done is to incorporate a purchase price into the projected cash flows. This can be done by accounting for the purchase price as an investment, and then iterating the value of the purchase price until the cash flows yield acceptable valuation parameters. Now that I've covered all the methodologies relating to the income approach, let's move on and discuss the market approach. Essentially, the market approach involves the use of comparable transactions or the valuations of comparable companies as benchmarking tools. Metrics derived from these benchmarks are used to form an opinion of value. The primary challenges encountered when using this approach are typically related to data availability and the selection of appropriate subjects for comparison. The primary methodologies used for the market approach are the comparative transaction analysis and the comparative company analysis. These methods can be broken down into 3 primary steps, which involves compiling a data set of the comparables, calculating the valuation benchmarks, and then using the valuation benchmarks to develop an implied valuation range. Implied fair market values suggested by market-based methodologies are often used to benchmark fair market value estimates derived from income-based methods. In circumstances where cash flows cannot be estimated with a high degree of confidence, such as for assets in the exploration phase, market-based approaches would be the preferred approach or may be utilized in combination with a cost-based approach. This slide demonstrates that the many different variables that should be considered when determining if an asset or company truly is comparable to the asset that is the subject of the valuation. When it comes to market-based methodologies, the identification of reasonable subjects of comparison is the most difficult and nuanced part of the process. And the fact that there are generally a limited number of transactions that occur during a given period of time or a limited number of companies that participate in a given market only exacerbates this challenge. When screening for appropriate comparables, you should ask questions like, has the transaction been announced or completed within a relatively recent period of time? Are the assets involved in the transaction or owned by this company comparable or located within the same basin? Are these assets similar in terms of commercial maturity? Are they similar in terms of the volumes assigned to the various resource categories? Are they similar in terms of ownership structure and commodity mix? And are they similar in terms of contract terms or applicable regulations? While screening for comparables, it's important to look out for clues that may indicate the existence of external factors that could affect the valuations. These factors include strategic value, which relates to a premium paid for an asset for some underlying strategic purpose. Financial duress, such as a company being obligated to quickly dispose of an asset in order to pay off its creditors and other financial obligations. Non-arm's length sales, such as sales involving parent companies and subsidiaries. And other compulsions to transact, such as companies capitalizing on tax advantages or using political or personal connections to get favorable deals. So this slide includes a non-exhaustive list of valuation metrics commonly derived from market analysis. On the left are metrics that are derived from comparable transactions. These include cash flow multiples, which are determined by dividing a purchase price by an asset's annual net cash flow. Reserves multiples, which are determined by dividing a purchase price by reserves. typically 1P or 2P reserves, but multiples can also be generated using 1C or 2C contingent resources. Production multiples, which are determined by dividing a purchase price by the current rate of production, either on a total barrel of oil equivalent basis or on a discrete oil and gas production basis. Acreage multiples, which are determined by dividing a transaction value by the gross or net acreage. And then on the right, you'll see metrics that are derived from the valuations of comparable companies. Some prominent metrics would include the enterprise value multiples. Enterprise value is a measure of a company's total value, which is determined by adding a company's market cap and debt and subtracting away its cash. Enterprise value multiples can be generated against production, reserves, and earnings. EBITDA multiples. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Multiples of EBITDA are typically generated against production and reserves. R to P ratios, which stand for reserve to production ratios, and are determined by dividing a company's reserves by its production. This metric provides an indication of a company's current reserves life. And then finally, you have market cap multiples, which a market cap refers to the total dollar value of a company's outstanding shares of stock. And then market cap multiples can be also generated against EBITDA, production, and reserves. So this slide summarizes the results of a simplified comparative transaction analysis I performed for assets located in Argentina. For each transaction, I provided certain key terms or certain key points of context, such as the date at which the transaction was either announced or completed, the buyer and seller involved, the play that the assets were located in, whether the assets were conventional or unconventional, the asset maturity, interest type, and then I provided the 1P and 2P reserve multiples I calculated, the production multiple I calculated, and the acreage multiple, and then a brief description of the assets transacted. Of the 17 transactions I reviewed, 5 of these transactions included deal terms that were publicly disclosed. And then I'll briefly summarize some of the key observations that I took away from this market analysis. The first observation is that each transaction included assets which were in various stages of development. No transactions were present which included solely producing assets or solely exploration assets. With the exception of the transaction between Vista and Aconcagua, the 1P and 2P reserves multiples are fairly consistent. And the results appear to suggest that a $3 to $5 per 2P BOE valuation is indicative for Vaca Muerta assets in Argentina. Another thing I observed was that only one of the transactions, the transaction between Geopark and Phoenix, involved the purchase of non-operated working interests. And then the reserve metrics related to this transaction are on the lower end when compared to other transactions. This provides some support to the idea that the market is pricing in a premium for operatorship. However, this would need to be confirmed with more data. I observed that in this analysis, there was a large degree of variability in the production multiples. This could be related to factors such as reserves mix, commodity mix, or other factors I was unable to identify. The acreage multiples appear to be fairly consistent. This is not surprising in a resource play such as the Vaca Muerta. And then the last point I wanted to highlight is that I determined the eco deal represented a distressed sale, and that the terms of the the Vista and Aconcagua deal were not standard. And as a result, I concluded that they did not represent transactions that aligned with the definition of fair market value, and I disregarded them from the analysis. This slide provides a sanitized view of a comparative company analysis conducted by D&M. We generated this analysis from regulatory filings of oil and gas companies listed on the New York Stock Exchange. Essentially, a company that would be the subject of valuation would be compared against its peers in this data set. And then an opinion of value would be determined by benchmarking the subject of valuation against the metrics exhibited by its peers. Moving on to the final valuation approach, which is the cost approach. The cost approach is the least commonly utilized approach, as it is generally only applicable to the valuation of exploration assets or equipment. This approach provides an indication of value by calculating the current replacement or reproduction cost of an asset. I'm not going to spend too much time covering this approach in any greater detail, as it's only utilized for the valuation of exploration assets, like I said, and the concept is relatively straightforward and simple to implement. The figure in this slide was taken from the SPW's annual parameter survey and provides a non-exhaustive ranking of the various valuation methods based on their relative usefulness according to survey respondents. At the top of the graph, I categorized each valuation method by approach. And then there are a few key observations that can be taken away from this slide. One observation is that the use of discounted net present value was by far considered to be the most useful valuation method. Another observation is that survey participants appear to favor income-based valuation approaches over market-based and cost-based approaches. In terms of market-based approaches, it appears that survey participants considered methods using cash flow multiples to be the most useful. And then lastly, there appears to be a strong opinion that acreage multiples are the least useful valuation method among the various valuation approaches considered. The figure presented here illustrates which valuation approaches are considered to be applicable during the various phases of an asset's development. You can see that cost and market-based approaches are most applicable while assets are in the exploration phase. However, as assets mature, it becomes more appropriate to value assets using a combination of the income and market approach. Here, I'll briefly highlight some of the practical differences between domestic and international valuations. The first difference relates to the ownership of resources. In the US, rights to subsurface resources are owned privately, whereas in most other jurisdictions, subsurface resources are owned by the state. The second difference relates to the evaluation of ownership interests. In the US, interests are typically evaluated at the well level, whereas internationally, interests are typically evaluated at the field level. Valuation in the US is generally conducted on a 1P basis, whereas valuations conducted internationally are generated on a 2P basis. It is US practice to conduct valuations on a before-tax basis, whereas other jurisdictions calculate economics typically on an after-tax basis. And then finally, in the US, there's generally more market competition and higher availability of data, whereas internationally, there's generally less competition in a given market, and data availability is considered poor by US standards. So here, I'll go ahead and conclude by summarizing some of the key themes I covered today. When valuing upstream oil and gas assets, technical evaluations should strictly adhere to PRMS guidelines. When assessing project economics, certain key economic inputs, such as prices and discount rates, should be guided by market practice, such as the use of future strip prices or using industry standard discount rates. Multiple valuation approaches should be applied when assessing fair market value. And the approaches selected will depend on the project's maturity. Any market comparables should be substantially similar. Valuation practices vary by jurisdiction, and these differences should be taken into account when forming an opinion of value. And then lastly, when possible, in addition to fiscal factors, valuation should also consider non-fiscal factors, which differentiate a particular asset from other alternatives available in the market. That concludes my presentation. Thanks everyone for attending and for allowing me the time to speak today. If anyone has any questions, feel free to ask them at this time.
Bueno, Nathan, muchas gracias por una excelente presentación. Vamos entonces ahora a abrir el espacio de preguntas y respuestas. Tenemos 15 minutos exactos para poder dedicarle a este espacio. Raúl, te doy la palabra.
Sí.
Hola, ¿me escuchan?
Sí, te escuchamos, Raúl, perfecto.
¿Qué tal? Bueno, muchas gracias, Nathan. Excelente presentación. Voy a leer algunas de las preguntas que recibimos. La primera es, ¿cuál es la práctica estándar del mercado con respecto al uso de pronósticos de precios de productos para la valoración justa de mercado? Nathan.
Yeah, so standard practice for price forecasting is to use the latest future strip prices from an appropriate regional benchmark. So it's essentially the most unbiased price forecast that you can use, and it's market oriented. For example, if I were to be evaluating an asset in the North Sea, I'd use a Brent future strip. And then in addition to the strip, the prices would be adjusted upwards or downwards to reflect differences in quality and transportation costs.
Ok, muchas gracias. Vamos a una segunda pregunta. Esta dice, en un proyecto con un largo tiempo de preparación, ¿cómo se elige el tiempo cero para realizar el descuento? ¿Escogiendo el tiempo para reprocesar el estudio sísmico? Por ejemplo, esto supondría un desembolso mínimo de efectivo y penalizaría el PB10 del proyecto.
Yeah, so as far as selecting like an effective evaluation date that you'll be discounting your future cash flows to, generally you would pick just a current date or some reasonable date, like as a beginning of the year, mid-year, end year. As far as when you are going to schedule the costs into the profile for your seismic processing, those could be staged. It depends on how the costs are booked from an accounting standpoint. So if you're booking, generally you'll be running these cash flows on an annual basis. So you would just allocate those cash flows to the year that they're expensed. I mean, you'll allocate those expenses to the years they're expensed.
Ok. Vamos a una nueva pregunta. Por favor, proporcione más detalles sobre cómo los factores no fiscales pueden afectar el valor.
Right, so I didn't have much time to cover these in the presentation, and there are a lot to consider. So that's why I wasn't able to fit it in. So I'll give you an example of three non-fiscal factors that could affect value. One of these factors that you'll see sometimes in host government instruments is state participation. State participation can degrade value because the state is often given an interest that is carried either through exploration, appraisal, and less commonly through development. So essentially, they'll be given a free ride. So you'll have another party that has working interest in the project that doesn't have to pay any of their share of the costs. You also have things like contract stabilization. Stabilization allows for fiscal terms of the original agreement to be frozen at the time that the agreement was made. And so without stabilization provisions in your host government instrument, the government can come in and retroactively change the fiscal terms and make them more onerous to the contractor group. So if you have a stability clause in your contract, it fixes those terms and gives you some like stability moving forward by keeping your fiscal terms consistent over time. And then the final example I'll give is like the right of assignment. Assignment rights will be outlined in the HGI, and in some cases, in some contracts, states have the absolute discretion to withhold approval of assignment or change of control, so preventing a sale. And this gives the state leverage and the opportunity to demand changes, such as potentially renegotiating fiscal terms or demanding taxes or other payments that would not otherwise be predetermined.
Ok. Tengo una pregunta más aquí. ¿Por qué los enfoques de valoración se basan en net present value antes de impuestos y no después de impuestos?
Yeah, so we use pre-tax net present values in the US, and we use post-tax net present values internationally. So the reason we use pre-tax net present values in the US is because of the overall tax regime. Typically, when you purchase a property in the United States, the purchase price can be used as a tax write-off. So before a transaction's even made, it's hard to account for the tax implications if you don't have a transaction yet. And then also, depending on the size of the company, they're subject to different tax requirements and burdens. So for example, like independent oil and gas companies in the United States, like small independents, are taxed at a lower rate than like super majors would be. And so it's just been common in US practice for a long time to evaluate NPVs on a pre-tax basis.
Ok, gracias, Nathan. Una pregunta más. ¿Cómo puede la naturaleza de una participación en la propiedad afectar una valoración?
Participation in property ownership. I would just go back to what I mentioned about state participation. So the entitlements you get to production are going to be dependent on your ownership interest. So if I have a simplistic example, if I have 1 barrel of oil and I have a 50% working interest, on a very simple way, I would be entitled to 50% of the revenues from that. I mean, it's a little bit, and then another party would be entitled to the other 50%. So I'd get revenues from half a barrel, the other party would get revenues from the other half. It's a little bit more complicated than that because you have things like royalties and then potentially some overrides that will change the entitlement splits. But at a very basic level, that's how ownership affects the revenues you generate from hydrocarbon production.
Ok. Pablo, no sé si tenemos más tiempo para preguntas.
Sí, sí, sí. Yo te aviso, Raúl, tenemos todavía tiempo. Sí, sí.
Ok. Bueno, siguiente pregunta. ¿Dónde se debe buscar para construir una base de datos de transacciones comparables para un análisis de mercado?
So building databases are hard, and there are companies out there that specialize in this type of giving this type of product and making it available to the market. It takes a lot of creativity and diligence. In the past, when performing evaluations, I've used websites that publish oil and gas news, like Energypedia, the Oil and Gas Journal, Rig Zone, upstream.com, and the Journal of Petroleum Technology. And then if you don't have any luck there, I've had a lot of success focusing on individual companies in an area that I'm interested in, and then just scouring through their regulatory filings, annual presentations, and then various other press releases. And then before we go on to the next question, I wanted to circle back on the question that was asked about how interest affects your cash flows or your valuations. So one thing I didn't cover in the presentation, and for those who aren't in our industry, there are various types of ownership interests. And depending on the type of interest that you have will depend on how you structure your cash flow model and how you receive entitlements to hydrocarbons. And then certain interests have certain related benefits. So to give you a very simple example, a royalty interest is not burdened by any costs. And so if you had a 5% overriding royalty interest in a project, you'd be entitled to 5% of the gross revenues from the project without having to ever spend any money. And so those are very low risk assets to hold. And then another example would be working interests. which there are a variety of, but typically you'll see an operated and a non-operated working interest as the various types. And the difference between those two is that the operated working interest has the authority to make operational decisions and has broad control over like the pace of development. And so typically you'll see that operated working interests are given a premium in the market in comparison to other like non-operated working interests. And then for working interests, they're different from royalty interests because they're, depending on your pro rata share of the working interest, you're going to be obligated to cover costs and you'll be entitled to revenues. So you have the cost component being fed in there with the working interest. So just wanted to provide a little bit more context for that previous question. I didn't really touch on that much in the presentation, so thank you for asking.
Ok. Otra pregunta. En yacimientos maduros, ¿cuáles son las opciones de evaluación más recomendadas?
Oh, in mature fields, it would definitely be income and market, marrying those two, just a combination of those two approaches. As you progress and the asset becomes more and more mature, your cash flow projections become more and more certain. There's just less subjectivity there when you're forecasting production, when you have a mature asset. And so you're going to be more confident in your income-based analyses and the metrics derived from that. And then you'll just reinforce your opinion of value using your valuation benchmarks that are determined from your market approach.
Okay.
Bueno, Raúl, podemos ir con la última pregunta y vamos cerrando. Estamos justo en...
Okay.
Ok. Las curvas de futuros son tan volátiles como el precio spot. ¿Hay alguna alternativa mejor para elegir el precio de la valoración?
In my experience, what oil and gas companies do for the purposes of a fair market valuation, I would not recommend any other price forecast. But for other valuation exercises, such as like an internal valuation for a company, a lot of the times I'll see companies either generate their own price forecasts, or they'll use arbitrary flat prices. So they'll say, okay, we'll have a flat 50 price scenario, flat 60, flat 40, and they'll run these various sensitivities to try and get an understanding of how price fluctuations will impact project economics. You can make some, I mean, it's purely opinionated, depending on the practitioner, what price forecasts you want to use. I mean, it's not a secret that future strip prices are not accurate in predicting prices. But what I would say is that in terms of fair market valuation, the majority of people in the market are going to be using future strip prices. And so it's a good, consistent way to be comparing projects in the market. And so, yeah, I mean, no one has a good track record of accurately predicting prices. If you know somebody who does, get them in touch with me. I'd like to start some business or something with them. And so, but generally, yeah, I would recommend sticking to future strip prices, adjusting them for differences in quality and transportation. And then if you would like to look at sensitivities, but these sensitivities are just as arbitrary as a future strip price would be.
Bueno,
Okay. Muchas gracias, Nathan.
Thank you.
Muchas gracias, Nathan, por compartir tu experiencia con nosotros. Por tu intermedio también quisiera agradecerle a Juan Pablo Franco del capítulo Argentina del SPEE, que fue quien nos acercó a este webinar. Por supuesto también a Raúl Belkenov y el equipo que lo ayudó para hacer la moderación del webinar. No me quiero olvidar tampoco de Verónica Ferreira, que se ocupa de toda la parte logística y para que esto funcione y salga como sale. Y de nuestra traductora también, Matilde. Muchas gracias por la traducción simultánea. Y bueno, y también agradecerle a todos los que participaron de este webinar. Esperamos que haya sido de interés. Y bueno, esperamos verlos en el próximo, que como les dije, lo íbamos a tener a fines de septiembre. Así que bueno, muchas gracias por participar y les mando un saludo grande a todos.